Today we are going to explore two of the most closely watched Bitcoin treasury strategies in the entire world. Michael Saylor's company Strategy, formerly MicroStrategy, and Jack Mallers' new venture 21 Capital. These two firms are taking radically aggressive approaches to Bitcoin adoption at the institutional level. And while the surface story might seem to be bullish to support Bitcoin, the financial structures behind them introduce unique risks, I would say, and fascinating lessons for investors who care about long-term financial sovereignty. Let's start with Michael Saylor, my favorite guy in this space. Back in August 2020, his company, then called MicroStrategy, made headlines as the first publicly traded firm to adopt Bitcoin as a primary treasury asset. Fast forward today and it's gone all in. All right, the company has since rebranded to Strategy and holds over 538,000 Bitcoin, worth around $49 billion as of April 2025. That makes it the largest corporate Bitcoin holder in the world. But here's the thing, Saylor didn't just use company cash to accumulate all that stack. He used leverage, lots of it. Strategy has raised capital through convertible bonds, at-the-market stock offerings, and unsecured debt. The company's latest roadmap, dubbed the 21-21 plan, aims to raise $42 billion, half from equity and half from debt, to buy even more Bitcoin. What's important to note is that this isn't just about holding Bitcoin. Strategy is positioning itself as a public market proxy for Bitcoin exposure. Investors are buying MSTR not just for the underlying Bitcoin, but for the amplified performance they expect from Saylor's financial engineering. And that enthusiasm shows MSTR has traded at a premium to the value of its Bitcoin holdings, sometimes as high as 3.3x. All right, so now let's talk about Jack Mallers. Now, he is the CEO of Strike, known for helping drive Bitcoin adoption in El Salvador. In 2025, he launched 21 Capital, a BTC native corporate treasury that started with 42,000 Bitcoin, roughly $3.9 billion in value. It's backed by Tether, Bitfinex, and SoftBank, and it's going public through SPAC merger under the ticker XXL. It's pretty appropriate. Mallers' approach mirrors many of Saylor's tactics, using convertible bonds, raising equity, and positioning XXL as a pure play Bitcoin exposure vehicle. But there are some key differences too. Unlike Strategy, which evolved from a software business, 21 Capital was purpose-built to be Bitcoin native from day one. There's no legacy business, just Bitcoin. Mallers is also bringing his own spin to the investor's pitch. He's focused on metrics like Bitcoin per share BPS and Bitcoin return rate BRR, which aim to offer more transparency and performance insight than traditional Bitcoin ETFs or holding strategies. The claim is that starting smaller and more flexible, XXL can offer more efficient upside to Bitcoin's long-term appreciation. All right, to sum this up, both companies offer investors a way to get exposure without holding Bitcoin directly. Both are using financial engineering, especially leverage, to scale up their Bitcoin holdings. Both are making a bet not just on Bitcoin as a store of value, but on their ability to outperform through strategic capital structuring. But despite the surface similarities, the risks tools and investor profiles they attract are very different, all right? Let's start with how they raise money. Strategy under Michael Saylor has been aggressive. They've raised over $7 billion through convertible notes. These are unsecured, meaning there's no Bitcoin pledged as collateral. Investors are lending money based entirely on the belief that Strategy will be able to either pay it back or keep raising more capital. On top of that, they use what is called at-the-market equity offerings. That allows them to sell new shares into the open market at any time, okay? So using those proceeds to buy more Bitcoin as well. Their current plan, called the 21-21 strategy, aims to raise a total of $42 billion, half from equity and half of that from debt. So now compare that to 21 Capital. They're also using convertible bonds and equity, but on a much smaller scale. Their target raise is around $585 million. What makes them unique is how they launched. Their entire initial Bitcoin treasury, 42,000 Bitcoin, was contributed by founders like Tether, Bitfinex, and SoftBank. In exchange, those backers received equity in the company priced at $10 per share. That means 21 started with a massive Bitcoin position without taking on immediate debt. It's a cleaner entry, but it also ties them closely with some very high profile and sometimes controversial players in the crypto space. Now let's talk about debt structure. Strategy is sitting on over $7 billion in unsecured debt. That means if Bitcoin crashes and the company struggles to service that debt, bondholders don't automatically get any collateral. It's risky for lenders, and it puts Strategy in a vulnerable position if market conditions tighten. And remember, Strategy's original business software and analytics isn't generating much revenue, so they're entirely dependent on Bitcoin's price going up and their ability to raise more capital when they actually need it. All right, so 21 Capital, by contrast, has taken a more equity-heavy approach. Now, their Bitcoin wasn't bought, it was contributed. That gives them a bit more breathing room, but they are planning to raise money through convertible bonds too, and if market conditions turn against them, well, they could find themselves in a similar bind. What we don't know yet is how these bond terms are structured or how much flexibility they will have if investor sentiment cools. There's also a difference in how these companies treat Bitcoin as collateral. Strategy has been very clear they are not using their Bitcoin as collateral for loans. That gives them total control over the asset, but it also means higher interest rates and more risk in the bond market, okay? 21 hasn't announced any plans to collateralize their Bitcoin either, but given their backers and the scale of their ambitions, it's possible that that could change. If they start margining their Bitcoin, they open themselves up to some kind of liquidation risk we saw during the 2022 lending platform crisis. And that was an amazing time if you had capital on hand. Then there's the question of how these companies are valued. Strategy stock trades at a significant premium to the value of its Bitcoin holdings. That premium reflects investor confidence in Saylor's execution and the belief that Strategy will outperform pure Bitcoin over time. But it also adds volatility. In 2024, a 9% dip in Bitcoin caused a 35% drop in Strategy stock. That's how sensitive it is to swings in sentiment. 21 Capital is making a different kind of pitch because they're starting fresh. They're emphasizing metrics like Bitcoin per share and Bitcoin return rate. Their claim is that with fewer coins and more flexible capital, they can grow shareholder value faster than Strategy can at current size. So it's kind of like a war right now. There's risks there too, okay? They're going to public through a SPAC, and SPAC listings are notoriously volatile, especially in a market where investors are already cautious about crypto exposure. So while both companies are chasing the same goal, dominating as public market vehicles for Bitcoin exposure, they're using different tools, operating under different constraints, and attracting different types of investors. And those differences are going to become especially important if the market gets rough, which it'll eventually do, guys, like I've been saying with all my videos in the past. Let's take a step back and ask the question most people want to avoid. What happens if things go wrong? Because while these strategies look bold and exciting during a bull market, they do come with risks, and not just ordinary risks. These are structural risks, the kind that can unfold very quickly, unexpectedly, if even one piece of the system breaks down. Let's start with the most obvious one, the price of Bitcoin. Both Strategy and 21 Capital are built on the assumption that Bitcoin's price will keep going up. All right, that's the engine behind their equity valuations, their capital raises, and even their public branding. For Strategy, the danger zone starts around $16,500. That is the level where their debt could become unserviceable. But even a drop to $30,000, Bitcoin's long-term whale cost basis could be enough to create panic. In fact, back in November of 2024, a 9% drop, check this out, a 9% drop in Bitcoin triggered a 35% crash in Strategy's stock price. That shows just how much volatility is baked into that structure. Now let's move on to 21 Capital. They don't have that kind of debt yet, all right, but they're still exposed. Their entire model depends on investor confidence. If Bitcoin falls and they're in the middle of a capital raise, that money could really dry up fast. Their stock could sink before it even establishes a real trading range. And because they're so new, they don't have the track record to fall back on. The second major risk is leverage. Both companies are using it. All right, no doubt about it. Strategy's debt is unsecured, which gives them flexibility, but it also makes their bonds riskier. If credit conditions tighten or if the bond market turns against them, they could struggle to raise more money. That would put pressure on their ability to keep buying Bitcoin or even to hold what they already have. 21's leverage is much smaller, but the risk is still there. If they start using Bitcoin as collateral or expand their bond offerings, they could find themselves in a similar trap. The market will only give you cheap money when things are going well. But when sentiment shifts, the terms change very fast. Next is what I think of as the silent killer, loss of confidence. We've seen this before so many times in this space. It was the final trigger in the collapse of Terra UST in 2022. Once people lost faith in the system, the exit got crowded. Even a small crack in the story can lead to a full-scale run if the timing is wrong. Strategy's stock trades at a premium to its Bitcoin holdings because investors believe in Saylor's ability to outperform. But that belief is fragile. If anything shakes his reputation, like his recent tax fraud fine, or if the company needs to issue equity at lower prices, the premium could collapse. And if that happens, raising more money becomes harder, which just fuels the cycle. 21 is even more dependent on narrative. It's backed by Tether, Bitfinex, and SoftBank, names that carry weight but also scrutiny. if Tether comes under regulatory pressure or if a media cycle turns negative, it could undermine the entire model. That's especially dangerous for a company that hasn't even begun trading yet. And that brings us to the fourth risk, regulations, which Saylor loves, by the way, which is crazy. The more success these companies have, the more likely it is that regulators will take notice. Governments could decide to clamp down on corporate Bitcoin holdings, especially if they see systemic risk. They might tighten the rules on leverage or impose new reporting requirements on Bitcoin-backed financial instruments. They could even go after stablecoin issuers like Tether, which would directly impact 21 backers and liquidity strategy. And finally, we have the risk nobody wants to think about but me and Heidi, is contagion. If Strategy or 21 were to collapse or even suffer a major liquidity event, it won't just affect their investors, it could send shockwaves through the entire crypto ecosystem. I think it actually will 100%. We saw it with UST, we saw it with Celsius, we saw it with FTX. Once trust disappeared, the damage spreads and we buy. If a high-profile Bitcoin treasury strategy fails, it could shake institutional confidence in Bitcoin itself. I wouldn't complain one bit. It could cause a sell-off in other crypto-related equities as well. It could freeze funding for companies that were planning to follow in their footsteps. We will take advantage of that once more. I know I keep saying that, but we have cash on hand just for this. All right, so I digress. Now, let's be clear, Bitcoin itself isn't the problem here. The problem is what's being built on top of it. Leveraged debt, speculative platforms, public expectations. None of these things change Bitcoin's fundamentals whatsoever. If somebody says elsewise, they don't know what they're talking about. But they can absolutely distort the market and amplify risk in a way that feels a lot like 2022. And if the tide turns, we'll find out just how much fragility was hiding under the surface, which will be a very good thing in my opinion. So now that we've broken down what Strategy and 21 Capital are doing and the risks that come with it, let's talk about what this means for you as a crypto investor. And I can say one thing, it's very good news. Because unless you're planning to raise billions through bonds and equity to buy Bitcoin yourself, you might be wondering, why should I even care then? The answer is these aren't just isolated business decisions. These are signals. They reflect where the market is going, how institutions are thinking about Bitcoin, and how the next chapter of this space could unfold, good or bad. The first thing to understand is that we're watching Bitcoin adoption move from the individual level to the corporate level, all right? And when corporations adopt Bitcoin, they bring leverage with them, okay? They bring public market expectations. They bring debt, earnings reports, and short-term incentives. That introduces a whole new layer of volatility and fragility on top of something that was designed to be stable and decentralized. So as investors, we need to ask different questions. We're no longer just watching what Bitcoin does, we're watching what's being built on top of Bitcoin, because that's where a lot of the new risk lies. If you hold Bitcoin directly, you're exposed to its price, that's it. But if you're holding shares of a Bitcoin treasury company or investing in a product that uses Bitcoin as collateral, then your exposure is layered. You're now tied to management decisions, debt covenants, fundraising rounds, regulatory filings, and investor sentiment. Blech. All right, so that might sound manageable during a bull market, but during a correction or a bear market, those layers become liabilities, okay? Liabilities. Bear markets are that's going to be amazing to show what liabilities are out there. So the first takeaway is this: know exactly what type of exposure you have. There's nothing wrong with investing in companies like Strategy or 21 Capital, but you have to treat it differently than holding Bitcoin itself, which is super relaxing. One is an asset, the other is a leveraged business model. The second takeaway here is about confidence. Both of these companies depend on investor confidence. That's what keeps their premiums high and their fundraising engines running. If that confidence breaks, things can unravel very quickly. So don't base your strategy on someone else's structure. Understand it, learn from it, but don't let it replace the fundamentals, especially when it comes to sovereignty. And finally, this is a reminder of why self-custody matters. Bitcoin was created to let you hold value without relying on banks, custodians, intermediaries. It was meant to take the power out of fragile systems and not to become the foundation for new ones, okay? So as more institutions enter the space and these kinds of strategies are getting more attention, don't forget what brought you here. You don't need to own Bitcoin through a stock. You don't need to rely on someone else's debt schedule to protect your future. That is psychotic. You can hold it yourself, secure it yourself, use tools that prioritize your privacy and independence. If these corporate strategies succeed, then great. If they stumble, Bitcoin will be here, all right? It's not going anywhere. Man, I'm gonna be here buying like crazy. So if you do wanna check us out, lordingcrypto.com, you'll see exactly when we're gonna be buying. All right, but the network doesn't care who owns what or how they financed it. So take this moment as a signal not to follow, but to think clearly, because in a market increasingly shaped by leverage, hype, and headlines, clarity is your greatest advantage. I mean, just look at the last 3 months, guys. So here we are watching two massive experiments, because that's what they are, unfold right in front of us. Strategy and 21 Capital. Both are betting billions on Bitcoin. Both are trying to build structures that give investors access to Bitcoin without the friction of holding it directly. Seriously, this stuff makes me want to vomit. And both are walking a tightrope built on leverage, confidence, and financial engineering. Will these strategies succeed? Maybe. If Bitcoin continues to grow, if capital stays available, and if sentiment remains strong, these models could become the blueprints for how institutions into the public markets. But if just one of those variables falters, if price drops, if debt becomes harder to service, or if investor trust fades, the same strategies that brought success could bring serious fallout. This doesn't mean we root for failure. It means we stay honest about the risks. We stay grounded in fundamentals, because Bitcoin itself isn't going anywhere, but some of the structures being built on top of it might not last through the next bear cycle. So my final thought is this: stay informed, stay self-sovereign, and don't confuse someone else's playbook with your own. If you're holding Bitcoin, make sure you understand why. Make sure you're using tools that protect your autonomy, not just your portfolio. And if you're interested in exploring these tools a bit further and getting deeper into the foundations of real financial sovereignty, I highly recommend you checking out learningcrypto.com. That's where we break down stuff in plain language, from wallets to privacy to macroeconomics, so you can make decisions with confidence, not fear, like I'd say 95% of people out there, okay? We keep covering these developments here as they unfold calmly and clearly, just like always. Until next time, take care of yourself, protect your keys, and I'll see you guys in the next video.